Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by John Bolton, who's the principal of Squirrel Mortgages, a mortgage broker here in central Auckland. Welcome in again, John.
Cheers.
Look, obviously here to talk about the Auckland property market, which you're in up to your neck every day. Look, everyone is really interested to hear and to work out, I guess, what the Reserve Bank's restrictions on banks' high loan-to-value ratio mortgage lending is actually doing to the market, if anything. What are you seeing at the moment?
Okay, well let's start with maybe what's happening with first-home buyers and pre-approvals. So when we came into October, we had some of the banks basically starting to cancel a lot of the pre-approvals, but some of them held firm and continued to honour what was there. So we still had quite a big pipeline of pre-approvals through October and November. One of the things that we have noticed is that a lot of our clients that potentially have been in the market for a long time and unable to buy, where they've managed to keep their pre-approval, they've actually bought in the last 6 to 8 weeks. So that's great, but that's seen, I guess, our pre-approval pipeline reduce significantly. We're certainly not seeing the same level of pre-approvals that we've seen, over the last year and a half. So I think it's definitely a lot tougher out there for people with less than 20% deposit. We're just starting to see now, probably in the last week or so, the banks just starting to loosen up a little bit. So post-October, essentially they stopped lending altogether. Pretty much all of the banks within probably 2 or 3 weeks literally curtailed any lending over 80%. In the last week or two, we're starting to get the odd loan approval through at sort of 85 or 90% for very good clients, which sort of suggests what we were expecting, which was that they would initially stop altogether, try and figure out what's going on, and as they get more confident with the framework, loosen up just a little bit, because of course they still can write 10% of their business over 80%, and I think we'll start to see that in the new year.
Yeah, there's obviously everyone and their dog has an opinion on the high LVR restrictions and what impact they are or aren't having on the market. We've had a lot of the real estate agents this week, Barfoot and Thompson, Harcourts, make their comments. We had some figures out from Property IQ on first home buyers. We get obviously the weekly mortgage approval figures and the Reserve Bank's sector credit data, all those things and various other things that add up. But I guess probably the most interesting one that we've seen thus far is the Reserve Bank's own figures on high LVR lending and how it fell from 25% in September to just 0.7% in October. So that does, as you say, suggest the banks just completely slammed the brakes on, and now we're seeing a few signs of life from them in this space again.
Yeah, I mean, from what I see, and I guess I'm a mortgage broker, but I'm also fairly active in the property market myself. It's definitely impacting, it's definitely changing things. I mean, the single biggest thing that I've seen that sort of points to it shifting is the auction clearance rates, which, we're running really high and now potentially below 50%. That's suggesting that things are changing, maybe some of the subtle things that, buyers with less than 20% deposits are having to get valuations. Now, if you went back 6 months, some of the banks were waiving the need for valuations all the way up to 90%. And in the absence of a valuation, there's really no check to ensure that people just don't keep paying more and more and more for the same property. So the fact that literally any purchase over 80% is requiring a registered valuation in of itself is putting some sensibility maybe back into that part of the market. So I think, all of those things are happening. Some of the inner city suburbs, which I find quite interesting, are places like Westmere or Grey Lynn. And if you take Westmere as a classic example, if you went back 18 months, it was probably the hardest suburb in Auckland to buy into. There would only be 2 or 3 properties listed. They would invariably be going to auction and they would be going for crazy prices. Now, it's an interesting suburb because there's a lot of old houses in there, and then there's a lot of really flash done up houses. So it's a classic suburb where builders would go in, renovate them, and then sell them for top dollar and make a lot of money. if you look at Westmere at the moment, I think yesterday was probably about 28 listings in there. And a large number of those listings are failed auctions that are now priced by negotiation. And to me, that's just the edge coming off that market, whereas those properties would have been going out the door at record prices just week in, week out. Even that market's starting to slow. But now it's not saying that they're not getting sales, but Westmere had 3 properties on the market, it's now got 28. And at least half of those are by negotiation.
Couple more questions on this for you. Firstly, are we seeing people who don't have a 20% deposit find any innovative ways of getting around it yet, or any banks or other entities coming up with offers that will help them do this? And secondly, what is all this meaning for property investors? Maybe there's a few more opportunities for them in the market now? So
I think Harcourts were trying to put their nose at the RBNZ this week with those comments, but there really is no innovation out there. You can't put second mortgages behind bank mortgages. There's very little in the way of non-bank lenders in the New Zealand market. There's Resimac, that's about it, and they're pretty small. The only way around the rules is really to involve parents. We've certainly seen a bit of that. We've got, I guess in central Auckland we're dealing in the middle to upper end of the market, so we're dealing with parents that are in a financial position where they can easily help their adult children, and they do. So so we're still doing probably a reasonable amount of lending where there's some sort of parental involvement, whether it's a guarantee, whether it's a joint purchase of a property where the parents actually take a stake in the property, or whether it's just early inheritance. Parents have become a lot more involved than they were 12 months ago. That works in the middle to upper end of the market. It doesn't really work in the middle of the market. At the bottom end of the market, you've got welcome home loans where it fits. So it's kind of that sort of lower to middle part of the market, I think, that's really missing out at the moment.
And the property investors, what's all this mean for them?
Mixed bag. Personally, it's there's the opportunity to potentially pick up some better buys because there's less competition in the market. There's a potential for properties to, maybe fall through the cracks, especially at this time of the year. So I think there's investors out there now that are sort of starting to sense that maybe there'll be some good opportunities to buy. There's a lot of investors, younger investors, that are highly geared, that are just getting started and sort of trying to recycle their deposits on properties that I think will be finding it really difficult. They simply don't have the equity or the cash to continue to buy properties, and I think that part of the market's pretty dead. There'll be parts, just looking at Auckland, there'll be parts of the Auckland market I think are going to struggle a lot more than other parts, and I think South Auckland in particular. Where you tend to get sort of more highly leveraged younger investors, and maybe the classic sort of Kiwi family sort of trying to get ahead in investment property where they don't necessarily have high incomes, are leveraging the equity in their existing property, buying in South Auckland, doing that 2 or 3 times, which is largely what drives the South Auckland market, and I think that part of the market's going to struggle more.
I'll ask you to get your crystal ball out now. What's going to happen next year? You've made some comments recently about Reserve Bank Governor Graham Wheeler perhaps coming under a bit of pressure. Obviously, it's an election year.
Yeah.
The housing market is a big political football. What do you see happening?
Yeah, well, I'll put on record first up that although I'm a mortgage broker, I am actually a fan of the RBNZ rules, because whenever I make comments on this, everyone assumes that I'm depressed and anti the Reserve Bank. I'm actually a big fan of what they're trying to do, and I'd much rather them use policy than hike up interest rates. I just don't think interest rate increases is what we need. So I'm a big fan of it. I think it's working. I hope that it works through into next year. I don't think we're going to get any major adjustment in prices. I think the market will, from what I'm seeing certainly in the last couple of weeks, I think the market will just settle down. and hopefully we'll just have a reasonably settled market next year. I think that will be good for everyone. Because if the market did slow down a bit too much, then I think you're going to see a lot of political pressure on the Reserve Bank. You're already seeing Labour Party come out today with a sort of anti-offshore, non-resident buyer policy. You just see a lot more of that sort of stuff starting to creep in next year as we head into an election. I think the Reserve Bank certainly won't want to become a political football. And I think they'll also be conscious of the fact that they won't want political parties giving away lots of freebies into the housing market come election.
Yeah, absolutely. Well, it's going to be a fascinating year. Thanks a lot for your time, John. That's John Bolton from Squirrel Mortgages, and I'm Gareth Vaughan at interest.co.nz.